The boom in India happened in 2014-15. That is when the first venture capital funds came into the country. Something very exciting happened. If your 2 coffees in a day are at a Starbucks,
You can't solve Bharat sitting in tier 1 or a metro.
I didn't join any angel networks, lost a lot of money by the way,
You did?
but then made 16 more investments, including pre-IPO companies.
Are we trying to say that VCs are not required?
If I don't need the funds, why do I need to go out looking for it? Battery Smart also the same thing happened. A lot of VCs rejected Battery Smart model because everybody said this e-rickshaw is illegal. Yes, of course it is illegal, but it still runs around. One generation spends time building the business. Next generation comes in. Next generation wants to grow the business. But how do you grow?
You kind of got some lesson to invest better.
Look, once you've written the first check, let somebody else write the next check.
A lot of VCs are usually the McKinsey and Bain consultants, right? And guys, welcome to another electrifying episode of the Akash Gupta Show, powered by 100 Unicorns, our new sponsor. India ke one of the top accelerators focusing on early stage startups. Backed by Venture Catalyst, a global startup accelerator. अब सभी startups के लिए एक बहुत ही काम की बात. ये अपने fund 1 से अभी तक 145 startups में $100 million का investment कर चुके हैं. In industries like fintech, edtech, Web3 and deep tech. Some of their portfolio firms are Videoverse, Zingbus, Snapmint, TrueNative, BlueSmart, and even आपका अपना Zip Electric. And now they are on to their second fund where they are looking to invest $200 million in 200 startups this time in sectors like D2C, Agritech, SaaS, and FinTech. So if you are a startup and you're looking for funding, then you know who to reach out to. So today we have a VC friend in the house, right? Who is one of the most jovial guys that I have seen in the entire VC ecosystem. Your banters are mind-blowing. और हम आज वही करने बैठे हैं, right? Welcome, first of all, Anup Chief. Right?
Thank you.
Yeah, we've been chasing you and for so long. Now finally you're here.
Yeah, my pleasure. I love to see your office. So it's a real pleasure. Such energy.
Thanks, Chief. आज आपसे कुछ चीजें ये समझेंगे कि आजकल क्या हो रहा है ना, every founder wants to be a VC. And every VC is also opening a fund, by the way.
Yeah.
Case in point.
That's right. Absolutely.
तो क्या हो रहा है ये सब और क्या सही है क्या गलत है, थोड़ा सा आप गाइड करिए. दैट फर्स्ट ऑफ ऑल योर जर्नी टू बिकमिंग अ VC, हाउ ऑल दैट हैपेंड, एंड देन हाउ एक्साइटिंग इट इज. Let's maybe start with that.
इसमें थोड़ा सा आधा घंटा लग जाएगा.
चलिए शुरू करते हैं. हम बीच में पोक करते रहेंगे.
That's fine. Yeah. So look, I was a typical corporate guy. So I started my career with Procter & Gamble. In fact, I joined their office in Mumbai as an assistant brand manager. Started selling soaps and shampoos for a living, and then moved on to different companies. But in the middle, something very exciting happened. So in the first dot-com boom, there was a company called India.com. It was funded by News Corporation, and it was a competitor to Yahoo and Rediff. So I happened to be part of the early startup team. I was one of the first few employees. And Sunil, who was the CEO, then lured me to Bangalore. So even before Bangalore became the startup capital of the country, I kind of, arrived over there to work in a startup. So that was my first exposure to entrepreneurship. And I also felt a tug, right? A real tug inside me. Wow. That perhaps, this is what was meant for me. Okay.
This was which year?
This is back in 2001.
Which is just 5 years after your MBA from F.
That's right. Wow. So whilst I had a, creme de la creme kind of a job from campus with P&G, etc., and I was very happy, I felt that there was something, that beckoned me as far as startups and entrepreneurship was concerned. And this was a horizontal portal, right? And but that was not the right time. Okay.
You realized that also?
That was not the right time.
How long you did that?
I was there for about 2 years.
2 years?
2 years, yeah.
Setting it up?
Well, with the team, and of course, working I was like heading up e-commerce actually.
Wow.
Right. So it was very funny that I was shipping cassettes and CDs and books at that point of time before Flipkart did that for all of us. Yes. And I was also part of the marketing team responsible for, the launch of the portal, which we did very handsomely. So I had this thing inside me I think, which I had to suppress at that point of time because the dot-com bust happened. And we went back to corporate world and corporate jobs.
Wait, so quickly the dot-com bust
2
happened?
years it was over. That was the time that Sabir Bhatia sold Hotmail for, I think, 500 crores. Right. And those are the days. Right. So, yeah, this was the beginning. This was the AOL time. This was the original, sort of tech boom time. Right. The first one. Right. But we weren't ready as yet because internet access was still via broadband. Remember the boom in India happened in 2014-15. That is when the first venture capital funds and the first venture capital startups came into the country, right? Because we got access through 4G phones, right? Smartphones changed the face of internet access in the country, and the rest is history.
No, but I'll hold you on there, because if you were building India.com and you would have approached a VC at that time to raise funds, which could have been the stellar Flipkart, the VC would have reverted. You're a little ahead of time for us.
No, that's true. So, that was my first exposure, and it was a dream come true, right? I dreamt that, there'll be a big payout, a big cash out. I'll buy an island in Hawaii, etc. All that. I'm joking, but I mean, there was a big payday. That's why all of us joined. The big kicker for taking the risk was obviously to explore more about yourself, to fulfill yourself professionally. But there was obviously a monetary kicker as that, right? That was also the part of it. And what you see today, Koramangala used to be a desolate place. Today it's choked with traffic. 6 block Koramangala. But the place where I used to stay, which was 3rd block, Raheja Residency. In fact, a lot of people know about it. It's right behind the Wipro office. Still standing. And obviously the place has become a bustling mini city of startups and everything. And now it's got extended into HSR, which we know is very famous. So I experienced that pretty early on. But then I had to go back to the corporate world because this world was over for another time, right? And that came back to me after my meandering career, if I may call it, through the corporate world. After I'd worked in Whirlpool, I'd worked for Yum Brands, both here in India and Australia. And then with Bata, it came back to me in 2015-16. Wow. When I saw the entire boom happen now through the palm of our hands. I said, this is it. Mm-hmm. It's only going to take off from here. Wow. Every Indian, of course, every other human being is going to now access more and more of their life on the palm of their hand through their smartphone. Wow. Everything is going to be done from there. So we had started cord cutting. We were not watching, Saas Bahu serials and Star World and whatever. We had moved on to Netflix. We were ordering products through Amazon at that point of time. We were, relying on taxi aggregators. We were experiencing the Uber and Ola in our lives at that point of time as well. Flipkart had come in the country as well. The first of the venture capital funds were also set up at around that time. So it's a kind of a coincidence, and in a way, it is a no-brainer that both emerged at the same time. And of course, cheap data had a lot to do with it. 20 cents a GB. This is a crazy cost of accessing the internet. It still doesn't exist.
Jio had already come in there.
Jio had come in at that point of time. So we all know how YouTube took off after that, right? Insta after that, WhatsApp became super big, 800 million users. We are the largest market, blah, blah, blah. So that's when I started to do some angel investing.
Okay. How did that happen? Thoda sa batao.
So, look, I didn't have any bright ideas like you as founders. I had done 20 years of corporate life. I said, how can I be still meaningful? So if I don't have any bright ideas, I don't want to be a founder, then I better work with founders, right? And the best way to work and to lend my experience, the operating experience that I'd had, and bring it to meaning in the startup world was to first work in early stage, right? Because this is where founders like you can possibly find more meaning to have, another sounding board to discuss ideas, filter through things, and maybe get some suggestions, etc. So it is more than money, right? Secondly, risk excites me, right? The possibility of solving real problems, like the way you and Zip are doing, right? That really excites me.
Wow.
And India has to solve a lot of problems on its way to becoming a developed country. And today, or rather in 2014-15, we got access to the best tool in the world, which didn't cost a lot of money. And that is the internet, right?
And that too on a smartphone.
That too on a smartphone. So that changed every Indian's life, as we know, in the last 10 years. With UPI, everything else coming in, we all know how it has happened. So what we take for granted today, we could see that. So therefore, I was super excited. I said, let me, start risking some of my own money.
Okay.
I didn't join any angel networks.
Sure.
I went through, some referrals and lost a lot of money, by the way.
You did?
Yeah, I did. I made investments in 4 different companies in 4 different formats. I learned that 2 of those formats were complete disasters.
Really?
Right, for different reasons, right? And one of them is still, very much alive, but in a different avatar and doing rather well. And that is Stage.
Wow. Oh, you invested in Vinay's company.
2016. Wow. I was one of the first investors, and a pretty heavy check at that. That time it was 16 lakhs.
Amazing, actually. That's great. And you did it through a network or direct?
No, direct.
Direct investment. Vinay approached you and...
Vinay and I came to be introduced through a friend of mine who knew both of us. So as I said, it was through referrals. I met him, felt instantly energized. So that's and I could see that vernacular, etc. All of that will come. But at that point of time, it was called Vitifeed, the publishing platform, and later on the Stage in its current avatar,
which is a nice avatar.
Yeah, which is a great avatar, and that also made a lot of sense. I mean, when they pivoted from the publishing to the media side of things, and that to the vernacular side, and they're so apt for it. They are from that background. They understand that user, and that's what makes it so special. In fact, this is one of the things that I look forward to, right? When you're solving Bharat's problems, you can't be solving it out of if your 2 coffees in a day are at a Starbucks.
You can't solve Bharat sitting in a tier 1 or a metro.
You can't do that. So so I really liked about that.
And you were working then?
Where?
You were working in Bata or some organization when you made these angel checks?
No. So I had complete goodbye to the corporate world.
Wow.
I was done. I was mentally...
And you were just chilling like that European guy for 10 months, 12 months?
I wish I could. No, but I was working with some of these companies. Okay. I was advising and investing money. Also a B2B startup out of Bangalore. Then I also invested money in a JV, which was meant to do hydroponic farming in Himachal. Wow. And where the JV was with an impact fund. So I think these 3 or 4 investments of mine. But yeah, I mean, the one which is surviving and which is doing well, and I have no doubt that they will scale to better heights and great heights, and will be an amazing company is Stage.
1 out of 4 was a success.
1 out of 4 was a success rate, so not so bad.
Not bad, actually.
Not too bad. Money ran out. I said, this is all that I've...
I'm sure it would have given you the investment back or much more. 1 success out of 4.
Well, hopefully it will. I haven't cashed out. I haven't sold.
Oh, yeah. But you can see that light.
I can see that it will happen. And the potential is so much unrealized that I don't want to leave it as yet. So that gave me also very valuable lessons around investing. Nice. Right? And it helped me through those failures to understand as to what failed inside. Right? And through that, I think that I was ready to become a VC, to do things on a bigger scale. Really? And that's where, Orios approached me, joined as a partner, rather managing partner in 2018. Wow. My first investment was a health tech company, which I led, called Bito. So Gautam and Yash, tackling the problem of, integrated holistic, health management program for diabetics. And diabetics is such a big thing in the country. It's 12% of the country is affected by diabetes. And we didn't have a digital health play in the country at that point of time for diabetics. And this is a lifelong condition. Unless managed very well, it can lead to, and virtually every family has been directly or indirectly affected by it. So I started off with that, but then made 16 odd investments, over the next 6 odd years.
6 years you were with Orios, right?
Yeah, that's right. So 3 different funds, 3 different vintages, including pre-IPO companies. So MobiKwik.
That's amazing. You were in MobiKwik?
No, but the pre-IPO round.
Pre-IPO you did. Oh, nice.
So that was 2021 before they filed their DRHP. Then there was Ixigo, which went IPO recently, and Vedantu and Kardeko.
Amazing.
So different.
So nice investments. Yeah.
Hopefully they will all work okay. Yeah.
Amazing. So what, I think those 4 learnings you said that you kind of got some lesson to invest better. Can you share some of those a little bit more? Yeah.
One of the things that I learned as an investor was that, look, once you've written the first check, let somebody else write the next check, right?
Don't double down so much?
Don't double down unless there is someone else who comes from a different perspective and is used to investing at that stage, is investing first. You may decide to up your investments, so double down, no problem, but let someone else validate that, right? Because not every investor, and same holds, true for me. I might have been lucky with some pre-IPO bets, but I think early stage, for example, is one specialty. There is growth, and then there is late stage. It's very difficult to transfer skills, right, so readily and overnight from LP becoming a GP, or GP becoming an LP, or an early stage investor becoming a late stage investor. I frankly wouldn't know how to write $100 million check, right?
Your appetite has to be known to you.
Yeah, it's your passion, it's your horse sense, it's what you're trained for, right? We have the Olympics going on. It's difficult for a 100-meter, specialist to go ahead and do a steeplechase, or to become a 1,000-meter specialist. It's a different skill. So, and the same goes for every other sport, right? I mean, whether it's swimming, whether it's anything else. So, even in the world of investing, I learned, this was my first one. Because I went double down. In fact, I went triple down.
Oh, you did?
Yes, to support the founders. And I felt that while I was right emotionally in terms of wanting to support the founders, but I was not being right and rational as an investor, right? So that is something that stayed with me, right? It also, I think, made their task a little bit easier. So they took it a bit easier. I feel that if this had pushed them out to seek validation and to go out and pitch, it would have made them more resilient. And maybe they would have got inputs which probably would have made the business survive a little longer or do better.
Sure, makes sense.
So that was the first lesson.
Solid one.
Yeah, solid one. The second one for me was on this JV. It is very difficult to align interests between 2 different investors who are coming in with different motivations. Difficult. It's not impossible, but it's difficult. So here we had, we had a CEO, come founder. He was an investor as well. The 2-3 of us were angel investors, come, sort of supporters, if I may call it. And there was a JV with an impact fund. Now, the impact fund was more interested in evidence. The impact it's having on the environment, the impact it's having on the livelihood of the villagers, right? We were commercially oriented. Back in 2015-16, I don't think anybody had heard about hydroponic farming, right? So if it was done properly, right, would it not have been a success?
Sure, it would have been. And there's so much talk about it now.
Absolutely. So it's only in 2020, 21, post-COVID, I saw hydroponic vegetables and things like that appear in our supermarkets, which means that people are understanding what this concept is all about. It's more healthy, it's organic, no pesticides, all that stuff. And now a lot of companies have come in. In fact, I have looked at companies, doing exactly that style. So the relationship with two misaligned interests on the cap table.
Oh, that's the worst thing on the cap table.
So that taught me a lesson that, look, tread this, and this was a 50-50 JV. So you have an equal say, It is almost like choosing your partner well or choosing your co-founder well, right? So it had multiple lessons in it. So today I have thanks to that, I have a much better sense of intuition. Even when I meet founders, I have been sometimes, and apologies to people who have said this too, hopefully it's been useful to them. I think they have found it useful. I have been blunt enough to say that, look, I like everything, but I don't think you guys are going to hang around for too long.
Wow, you've said that?
Yes. And very often people have respected that. I've seen the teams break off after some time, right? So, and there are telltale signs, even when founders are pitching.
Oh, really?
Yes, you can make out lack of cohesion. You can make out the body language. You can make out chemistry, right? You can make out if there is a hint of,
Discomfort.
And there'll be underlying reasons. One guy is trying to dominate the conversation, not letting the other person speak, or is trying to answer the question which is being posed. I would deliberately pose questions to the other co-founder.
It makes sense. That's a smart one, yeah.
So, because look, it's a long game, right? And especially for an early stage investor. If you're a late stage investor, you're 2-3 years away from an IPO, probably. But as an early stage investor, you got to stick around for 10 years, right? And how are you going to deal with, a constant churn, high churn? That's right. And which is why even in funds, you can't have high churn.
Yeah, because the legacy of knowledge, once goes away, it's madness.
Absolutely. So the people on both sides, therefore, are very important. Founders got to stick together to generate long-term value. So long-term partnership and ingredients for long-term partnership. So it was a lesson in that. Motivations, respect for each other, alignment of objectives, operationally, what do you hold important, what do we hold important, what is right, what is wrong. You're making financial decisions every day. Where do you want to invest your time and resources? Those can look very different when you have misaligned objectives. So, that was
lesson number 2.
Lesson number 2, and
right partnerships, right people,
create better long-term value. So my horse sense for choosing better founding teams, therefore increased. Right. Also, sometimes look, nothing is perfect, and while the essential ingredients are there, one might sense that there will be some issues coming up in the future, and sure enough, when they come, how to solve them, right? So very often, the term mentoring is sort of loosely used, right? I mean, founders need capital, and I think founders maybe need you to get out of the way sometimes when they're doing, okay.
Essentially, just they need capital in most of the cases.
But founders also need ideas, and the founders need help. I think they appreciate that when you help them on their goals by opening some door, by reaching out to a person they can't reach out to. And sometimes when you have or sense issues, then you step in, and I think my age experience being generally, more than the founders also helps me. It's my advantage.
You've been a person who've run businesses.
Yes. So I've been an operator.
At the top.
Yeah, I've been an operator. Yeah. So no issues. Electricity is not working. Water's there. Cops are outside. Some.
You've seen all that?
Yeah. Jalouse is happening. Some. It's part of retail. Yeah. Look, you have to deliver on your targets amidst all that is existing at the macro and the micro level. right? You can't take excuses, right? So it's a live business, and retail, there is nothing like retail.
But tell me one thing on this, that a lot of VCs are usually the McKinsey and Bain consultants, right? And I don't want you to laugh on this so early. And on the other hand, I can see that you've been an operator also. And I'm sure that you've seen all sorts as friends, as partners, and we don't want to pinpoint anyone. But what's the right VC? Who's the right VC? Any traits that you can guide people on, that, hey, these things you should have done to be a VC?
Interesting question. I wish somebody had written a book, and if they haven't, then maybe I should write one about it if I can get to it.
We are starting today.
Look, I think first of all, passion for entrepreneurship and helping entrepreneurs, right? You've got the book Ikigai over here. So you have to do something that is meaningful to you and the world, right? And it should not feel like you're coming to work, right? It's like you coming over there and leaving a piece of you, right? Every day. And that's what I feel entrepreneurs do that every day when they're building their companies. While we can, depersonalize and say, yeah, you're building product, you're building this and that. Actually, they're building legacies. Every founder wants to build something that is larger than their own selves, right? And therefore, is that your passion as well, right? If you're just going to look at balance sheets and P&Ls, then you're much better off in private equity. So first of all, I want to make that differentiation. PE is not VC, right?
We'd want to deconstruct that also in a bit.
Yeah, we can deconstruct that. An early stage VC is very different from all other VC.
Sure.
Right? Early stage VC is as close to being a co-founder as it gets.
Really?
Yeah.
So that's why you said that the number one trait is being in the skin of the entrepreneur.
Passion for the entrepreneurship and being in the skin, having built something yourself, having been part of a startup as well, right? It's okay to be a XYZ, whatever brand of consulting and have had degrees, etc. But have you actually worked in a startup? Have you actually built a startup yourself, right? Have you actually done investing yourself? And I think that's the next trait. If you haven't risked your money, how can you handle third-party money? Most funds are 98% third-party money.
And that's almost like entrepreneurship again. Money management is business. Absolutely. It's real business.
It's real business. Yeah. And I would give more credit to domestic VCs here simply because of the fact that they are founders themselves. Okay, they have set up a fund management company.
Right.
They have raised capital from domestic investors by painstakingly explaining to them what this class is all about.
True.
Most people only understood real estate, gold and mutual funds and stocks and nothing beyond that. Right. So what is this asset class? Right? And then they get the heebie-jeebies when they find that, out of 20 companies and, maybe 100 crores invested, 50 crores has disappeared because the companies have shut down, half the companies. How do I understand this style of investing? Where the loss ratios can be quite high.
Yeah.
And the power law, of course, kicks in. But everyone's style of investing is different. So every early stage VC is not following the same book, right? So therefore, while the ingredients for a VC at a broad level may be, similar at a certain stage, and therefore I'm going to differentiate at the early stage, you need passion for entrepreneurship. You need to have worked in a startup, need to have built a startup yourself, done investing, risked your own money before you can ask for third-party money to be risked along with yourself, right? And then shown discipline. And I think discipline is very, very key. Because if you don't have the discipline, then the learning number one that I had, which is don't double down and triple down. Let someone else come in and then you double down, right? And then also hold your check. There has to be diversification in the folio. At the time of exits in 2021, many early stage funds, they were sitting on gold mines, but they didn't sell. They felt that it's only going to grow upwards from here and not downwards. And guess what happened?
Madness.
It didn't go upwards at all. In fact, it went downwards.
21 was the last time when it was high.
So you were left holding the can for a good 3 to 4 years, waiting for the business cycle to correct itself, or waiting for both the business cycle and certain steps that you took inside that company between equity and debt to correct itself and balance itself out. So liquidity in this asset class is a matter of discipline. You have to take money off the table when there is supernormal profits being made, when the IRR is looking good. If your target IRR is, let's say, 25%, if you're making 100% IRR, you should take some money off the table.
Yeah, you do the, what do you call it, stop loss or, gains, cap your gains and exit.
Yeah.
Don't be so greedy.
Don't be greedy. Every investor is driven by fear and greed. There is no doubt about that. I'm sure every startup.
Everyone is a paranoia every day.
But this is where discipline kicks in.
Yeah.
Right? So this is a big lesson as well. And this is a big ingredient for being a successful VC. So I think if you combine all of these, I would say at the early stage, operators would tend to be more successful.
Makes sense.
Because they can really work with the founders. They have experienced scale. They've experienced 0 to 1 and maybe 1 to 10, where they were operators. They can bring those learnings. This is not possible if you've been a pure play financial advisor looking at things on an Excel sheet and never gone out and sold something, never gone out and met a irate customer, right? You haven't experienced the pre-PMF journey, so to speak. Right? And you've only met sophisticated, LPs and sophisticated investors. It's a very different. That's the late stage and the growth stage. When there is a lot more data in front of you, the teething troubles are over, product market fit has been achieved, and now it's a matter of growth. It's a matter of scale up. So what you're providing is actually more fuel to the fire. The fire is already lit. Right? And at the late stage, all you're looking for is making a private company go public. Right? And becoming, bigger.
Which is the PE play?
Which is the PE play or the late stage play, right?
Late stage is, can you define, like early stage is very clear, setting up the business.
Yeah.
And then there's a middle stage, which is the growth stage. And then there's a late stage. Can you just explain these, like late stage, why only PE and why not a VC?
The growth stage is when the PMF has been done. Typically Series A, Series B, right? More like Series A, right? B and C, you may continue to scale, you may continue to grow, but there are more of organizational challenges. Who's going to be number one? Who's going to be number two in that segment? What is the pricing play? How do you expand into different markets? How do you become a more sustainable model?
Profitability
comes in a big way. Today, thanks to the 21, crash, a lot of founders and thankfully a lot of investors are not going for this term called blitz scaling, which was a very popular term, They are going for profitability in the growth stage itself. So right after Series A and B, demonstrate profitability. And today's hot IPO markets in the country have shown you don't need to be a unicorn, right, through private investment to be wanting to list on the stock exchange. You can do much prior. All you need is profitability. They can be a 300 crore company doing a profit of 20 crores on PAT. Go and list yourself. There is no issue.
Okay.
Depending on the segment, you'll get what your multiple is. But provided you have the profit, right? Which means that you have a sustainable business model, right? What you're doing is giving an exit to all your investors when they should choose to take it. And when the company needs money, it doesn't have to spend 6-9 months of diligence, etc., approaching private investors. You can sell your shares on the stock exchange and get the money when you want.
But don't you think that's like very different than the VC play, right? So the VC play was that, hey, this is a 300 crore company. It's not generating 20 crores of profit, let's say. Yes. It's just, let's say, minus 10 crores today. It's not profitable. It's not counted as profitable. It's a little loss making. But 10 crores they can cover up. Possibly if they're doing a 300 crore kind of a revenue, right? And if I fuel in another 50 crores into this company, which is what, 7 million, 8 million, if I fuel that, then this 300 crores can become 1,000 crores.
That's right.
That's the VC play. That I understand. But when you're saying that this founder is not going to a VC now because VC is asking, hey, profit, then the play of VC in a way is straight away going to IPO. So are we trying to say that VCs are not required?
Well, good question. The market has also been affected by entry and sometimes sudden withdrawal and exit of late stage capital, right? In the 2014, 15, 16, right, that time, there were two big players. We know the two big players, SoftBank, Tiger, right? And the market was not very mature. The number of mobile phones in the country was not what it is today. We didn't have that kind of coverage, right? So market was not ready for scale up to a level where the company can become profitable at that business level and be able to achieve it. The growth was much slower. But post-COVID, the scenario has changed, right? Companies are able to scale with lesser capital. They are able to become sustainable. And maybe the role for late stage actually end there. Because for founders, raising capital means dilution. If I don't need the funds, right, why do I need to go out looking for it? I need liquidity today.
I'm profitable. I can scale slowly.
Correct.
You do not need a 3x every year. I can do a 30% every year.
No issues.
I'm doing 300 crores. I'll be 400 crores. I'm 20 crores. I'll be 40 crores. So that's a path towards profitability. So VC play is not required in that equation.
Late stage VC play is becoming less relevant as the market has become more mature. The number of mobile phones, people's habits are now much more easier to grow and adapt and become a self-sufficient model. This wasn't the case in 2015-16. COVID has changed everything. Yeah.
So the game has changed.
The game has changed.
But tell me one thing. Let's say now the same founder who is building a 300 crore company and a 20 crore PAT, let's say, and now he's saying that I don't need to go to the VCs, I'm going to IPO, right? How would he, like you were part of the Ixigo IPO now, and I still want to build, let's say, a unicorn. Would I get enough capital in the public market to possibly become a unicorn, which is an 8,000 crore company? How will that math play out? Because it's only 300 crores. So possibly I will raise 20% of 3x multiple of my PAT, or 30x of PAT is what is generally, I understand. Maybe you can correct me there.
Yeah, so let's say there is a 5 or 6 times revenue.
Perfect. Let's do that. 1,500 crores.
1,500 crores, right? And you're raising maybe 200 crores. Okay. Part of that is secondary, exits for maybe founders, maybe exits for some of your investors, so it doesn't go into the company. And primary issuance is, let's say, 50 or 60% of that, right? So you've got enough fuel, as much as a Series B round would have given you.
That's right.
Right?
That's right.
So you can now grow the company without the pressure of running out of the runway. Plus, you have shareholding left in the company that you can dilute further. You can take out a rights issue. You've got public shareholding, right? You've got people holding one share at a minimum each.
Can you explain the rights issue to me?
So rights issue is issued to your current shareholders, right?
You want to buy more?
Yeah, I want to buy more.
So out of the balance that I have, which is not public, which I hold, or
the company
holds, I'm issuing more shares. And if you want to buy, you can. Public can also invest in it?
No, this is only for existing shareholders, right? And there is usually a ratio. So let's say for every one share held, for simplicity's sake, you're offering one more share, right? For eligibility's sake. So you issue that right share. And that is no different from primary issuance to a private investor or a VC at the growth stage or a late stage. It's just that your existing shareholders, which is public shareholders, are basically putting in more money into the company to buy extra shares, which means that more shares are getting created, you're getting effectively diluted as a founder, and everybody else on the cap table is getting diluted.
It's almost like another round.
It's almost like another round. But it's now public, right? Your results are public. Every quarter you will be tracked. So the exposure is high. You will be facing analysts, you will be facing brokerage houses who will have, their own opinions. Somebody will take the graph up. They'll say this is a company which is, going forward, and it'll catch up, on the earning per share, and therefore, we can see a bright, rosy future. So this rights issue is very much, very much justified at this particular price per share. So so on and so forth.
But there's no negative light on the rights issue?
There's no negative light on the rights issue. Yeah, it's absolutely good to do. And if it gets subscribed and oversubscribed, right, it's a great sign.
It's almost like a IPO too.
Yeah, it's a great sign. It means that your existing shareholders have so much faith in the company, they can't get enough stock of the company that they are, they haven't left anything on the table. So, that's what it is. So if you want to approach the public, then that's a different thing altogether. You can get debt as well, but you're a fully liquid company, right? So the role of late stage VCs in today's mature, market in most segments is therefore kind of questionable.
Right? Which is PE also?
PE is a different play. So PE, look, is very different. VC was used to fund disruptions in existing categories by bringing in some IP and technology or a platform. Could be a marketplace, could be blah, blah, blah. Could be like what Zip is doing, putting buyers and sellers and, all of that, and creating a whole delivery platform. It was used to fund these new businesses, right? Which would disrupt old businesses or solve new problems existing around us, but are not getting solved by any other business.
Or multiply into more cities.
Yeah, you could grow, but once the product market fit was there, right? So VCs were funding these models and saying, I'm going to take a hit on the early, expectation of profits, won't be there. It'll scale to a level that eventually there'll be profit. That's what happened in the case of Zomato, as we all know, and many other companies. So initially the scale became important. Before scale became important, the validation of that, what is called product market fit, and therefore the need that you are hinging the business around became important. The fact that the company was making money on every transaction became important. And then after that, you were growing and only growing to a scale where you would be able to break even on your base level cost, which is your fixed cost. After that, the company turns profitable if it's profitable on every transaction. Even then, if this was not possible, then the role for late stage VCs came in. They said, hey, you need more money. You've grown to the scale. A lot of people are using taxi aggregators, but I understand there is no profit at the corporate level, which means the scale has to be even bigger, right? So they took that bet. So late stage VCs, the role was to fund those losses even into the later stages of a business where product market fit was achieved, but profitability was not achieved. So you needed more scale to cover up.
Was that the right thing to do?
It was the right thing to do. I think, look, Zomato is a clear example.
But there's one Zomato and there are 100.
Well, there's delivery, there's Policy Bazaar, there is, Nykaa, there's So I think there are umpteen such examples.
They're now getting profitable.
They're now getting profitable, which means that they needed that scale, right? And through that, you also pivot, right? GDP per capita also grows, right? During this period, it doesn't stay static. People's habits change. New consumers enter the space. So one's got to, as an investor, place a bet on all of that, right? It's not just today's investors, today's consumers. We're talking about a whole bunch of new consumers, right? Who have now grown up with taxi aggregators. So they understand this business and this is part of their life, right? It's like how we're talking about quick commerce today.
Yeah,
right?
but are taxis making money? Let's say Uber.
Not at this stage. So I think that there is still some work to do over there. So they haven't, I think, pivoted enough. Maybe they could have done the premium taxis model, right?
Or intervened enough.
They could have introduced new segments. Why one size fits all? There are multiple needs existing in the market, right? There is a need for a premium play as well. There is a need for a rental play which looks very different, right? So I think one size fits all really doesn't work. You have to have different segments. And that's the case in general, with India, because there are different socio-economic classes of consumers. To make profit overall, you need to have what we used to in food retail call the aloo tikki burger to get the customer into McDonald's. But then after that, he purchases far more, right? And then the habit kicks in. But you need that door opener at a very shocking price and something which is very relatable. So I think these are, now the question on private equity. Private equity is traditionally been designed around family businesses, which were good businesses, traditional businesses, manufacturing, industrial, equipment-led businesses, those kind of businesses. In order to grow, family business did not believe in approaching capital markets.
Which is the IPO.
They had a desire to hold the company very closely within the family. And because they feel that there'll be a loss of control. Now what happens? The parents build the business. One generation spends time building the business. Next generation comes in. Next generation wants to grow the business. But how do you grow? You have exhausted all limits of taking on debt, right? You can't make the company unprofitable by servicing too much debt. There is a debt equity ratio as well. So you've exhausted your own resources, which is profits, and leveraging to get access to capital through debt. So what do? So that's where private equity comes in, where you will find typically a single generation sort of peaked out, wanting to hand over to the next generation, or the next generation not interested in the family business, wants to do something else. So there is a liquidity which is desired. You want to encash on what you've built. You don't want to yet approach the capital markets because you're not yet ready. You're not at that scale as yet. You've got too much debt, for example. So you need a bit of restructuring. You need to bring in perhaps a professional CEO, a professional management team. To be able to afford that, you need infusion of capital. And you're okay as a family business to still retain control, right? But let go of a little bit of control to this private equity investor whom you have socialized over a period.
Post IPO, you don't have that control?
Post IPO, look, it's a public company. Then it's then it's up to the shareholders, typically speaking, and the board of directors, right? So you have to have a formal board, independent directors. You will be having a CEO. There are family businesses operating with the family itself as a CEO. There is no issue with that, right? But you got to prove yourself out. You got to work in the business. But it's been often seen that, look, after some time, maybe after a certain number of generations or age or something, people want to then take it easy, pass it all maybe to the next generation. But if the next generation is not interested and you don't want to let go of the business, then you bring in the professional managers and let them continue the company, and you just continue as shareholders in the cap table and keep getting the dividends, keep maintaining an oversight, have a couple of directors, make sure that that you're running the business properly. Private equity used to come in as a bridge to public markets or a bridge to a strategic M&A. So there was the style of investing over there is not taking risky bets.
And these are profitable businesses.
So these could be opportunities for scaling to 5x, but don't have the capital. And to address that, there are some of those problems that exist, structural in nature, whether it's management, whether it's debt, whether it's first generation, second generation, all of that. So that gets solved within that. Private equity also has non-control and control buyout. In control buyout, they go in for a 51% or even higher, and then the family basically transitions out of the company at certain defined milestones and certain cash outs. So it is all. So this is typical of private equity. They don't take risky, disruptive bets. There is nothing risky about. They're not going to take a bet on a quick commerce company today.
Yeah.
So they're always going to take a bet on an established company with established clientele, lots of years of history, profit and loss, balance sheets, diligence can be done on papers and numbers. Factories can be audited, warehouses can be visited. All of that, they'll go into the deep history of shareholding agreements that have been signed over a period of time, the debt that exists, all of that. So the nature of work is very different. This is absolutely not the work that an early stage VC has to do. Here you're meeting a founder, who's talking about his company or her company for the first time to any investor, right? So it's absolutely the earliest and the risky one.
So with that, let's take a segue into building a VC fund. Right, we know that everyone wants to build a VC.
Are you building one?
I'm learning. I'm learning on the show. I would love to someday, like everyone else.
Sure. Yeah.
So let's do that education if you can, right? So if I want to build a VC fund, what should I do? Where do I begin? Who is LP? Who is GP? I don't know anything.
It's funny, somebody asked me the question today.
Really? Someone has asked you today?
Yes, and the person is was earlier a co-founder in a company.
So you have to just repeat it then.
Well, I think the setting up a fund, pretty much like a founder, right? You're a founder all over again, but it's just that you're now a founder of.
You're not building a business, but investing.
You're investing, but you're building a business. It's a financial services business. It's an asset management business, right? So at least for people who are not bringing in global franchises, right? The global names into India or becoming employees or part-time partners or whatever, quasi-partners, not part-time. If you're setting up a fund of your own, you've got to do everything that a founder does. Select a brand name, select which is your stage where you're going to operate, select, what is going to be your unique, proposition in the market to founders. Why should they choose you over other VC firms? And therefore, why should the LPs or the investors who are going to put their money with you, why should they believe in you? Why should they trust you? Do you have a track record? It is the same thing. If you've been a first-time founder versus a second-time founder, raising funds is easier for a second-time founder, isn't it?
Yeah, it is.
Right? So it's the same thing for somebody setting up a fund. So it's easier if you've worked for a VC firm or some investment firm before. So you have a track record which says I took this much money and I was able to return so much amount of money in this much amount of time, which can then be translated into some key metrics, which is distribution to paid-in capital, which means basically cash return to cash invested. MOIC, which is multiple on invested capital, which means that the multiple that you got.
Portfolio return in that sense.
Portfolio return, but on the invested capital. So what happens is fund managers take a fee every year, which is 2%. So let's say after 5 years, 10% of the fee has been consumed, which means that if you took a capital of 100 rupees from your LPs or investors, 90 rupees is the invested capital. What's the multiple on 90 rupees?
Why? Where's the balance 10?
The fee.
That's 10%.
Yes, over 5 years.
Oh, okay, 5-year window. So any fund that you build is a 5-year window.
No, funds are typically built in with a 8 to 10 year horizon, right? They can be short-term funds, but not really at the early stage, and typically not in the VC space. Because it takes time, because you're starting and things are uncertain, it's risky, it's disruptive. Maybe in private equity, yes, you can do that, right? Maybe in late stage, perhaps you can do that. Maybe in case of secondaries funds, entering in at the growth stage with a typical mandate of, hey, we're going to exit all these companies with an IPO or acquisition, they can do a 5-year fund with possibly 1 or 2 years of extension. But typically VC funds, particularly the early stage, will be 8 plus 2.
Understood. Sorry, you went very fast there. So you said that I need to be a founder of the fund that I'm creating. So I need to get the thesis, get your
co-founder.
You need a co-founder. What do you call in a fund?
The two general partners.
GPs.
GPs.
GP is general partner.
General partners.
The guy who's raising the fund.
The guys who are raising the fund, the guys who are the owners of the asset management company.
Asset management company is in a way a VC fund.
That's right.
Right? And then what I do, so I have a co-founder, I have a brand name, I have a thesis selected now, maybe sustainability or whatever. Then what?
Then you apply for a license. So you have to do paperwork.
Without capital?
Without capital. You have to first get a license. Sure. It's a good old-fashioned license of, maybe...
Opening a private limited. So this one in this case is a license.
So before you can do a fund management business, you need a fund manager's license. That is given by the regulator because you're handling mostly third-party money. Right. So
it's almost like a mutual fund. You need a license.
Fund, absolutely. So it is a very big responsibility. You're handling third-party money. So the regulator has to step in to judge and evaluate your credentials through an application process, which is called filing the private placement memorandum, or the PPM as it is called.
Which website it will be?
SEBI's website.
Apply a fund. There's some link. Okay.
There are different categories of funds. In alternative investment space, there is Cat 1, which is Category 1, Category 2, Category 3. There are some guardrails around that. So depending on what's your fund strategy, equity, debt, mixed, public market, etc., you decide to choose one of the categories that is relevant to you.
Equity and debt also you can do.
You can do equity and debt.
Which is like venture debt?
Which is like venture debt.
So there also you have to apply on SEBI only.
Yeah, absolutely. All alternative investment fund managers today who by the Silicon Valley term as VC firms, they are all actually applying to SEBI to get a license for the fund in question. Every fund that you launch has to have a target corpus and a green shoe, which is basically the amount that you can stretch up to if you are oversubscribed.
Okay. What is green shoe? Can you explain?
Green shoe is the additional portion that you can raise within that license.
Okay, so while I have 100 crore approval, I have a green shoe of 20 crores?
Yes. So you can do total possible of 120 crores. So when you get the license, this is what it means. That you can raise up to 120 crores, but no more than that.
Got it. So there's a max and a min.
There's a max and a min. And so I mean a target and a max.
And Cat 1, Cat 2, Cat 3 are like basis the size?
These are different categories. These are different guys like petrol, diesel and,
But size wise hota hoga?
No, not size. It is about the application of those funds. So with equity, debt, public markets, private markets only.
So all VC funds are Cat 1 then?
No, they could be Cat 1 and Cat 2. Yeah.
And the angel funds are not Cat 1, Cat 2?
Angel funds is a separate category. It's a separate category because there the minimal investment to be made by each of the investors is only 25 lakh rupees. In the case of the AIFs, which are Category 1 and Category 2, these are the minimum investment is 1 crore Indian rupees.
Got it. From one LP?
From one LP.
LP is limited partner.
One PAN number.
LP is a limited partner.
LP is a limited partner. This is also a Silicon Valley term. Right? What it basically means, these are investors. Right? They can vote on your resolutions, right, on certain topics. And for example, to extend the fund, you definitely need a vote. When you make material changes in the PPM or the product, you need to approach on certain matters and get 75% approval, for example, the case of extension, right? So the regulator lays down all these guidelines in its AIF regulations 2012 and various amendments since then. Additionally, by the way, our life has become more interesting. SEBI has introduced an exam.
Oh, really?
With negative marking that you have to clear before you can even put in your application.
Really?
So there is a National Institute of Securities Markets called NISM. So there has to be at least one person in your key investment team, which means that if you have 2 or 3 GPs or 2 or 3 partners who are key persons and investment committee members, at least one of them has to clear that exam.
Really? It's online exam?
That's right. You have to go to the center. You have to take a test, without which you can't even apply.
No age criteria. Whatever age that you are in.
That's fine.
You have to.
Yeah, absolutely. That it's got nothing to do with your past experience and your degrees or anything. They don't care.
Someone prepares you for this exam also, or what?
There's a 500-page document you read through. You go through all the examples. So it's a recent phenomenon. Wow. So there is no coaching institute, if I may call it.
That's a startup idea.
That's a startup idea. How to train VC managers. Yeah. But I can tell you there are a lot of fund managers who are getting the heebie-jeebies taking that test. Yeah. That test is not a...
Only one time you can give, or you can give again?
You can give again until you clear. Yeah, you can give as much as you want, but it's not going to be averaged out. It's your best score which you to take through. And either it's like a yes or no. Sure. Either you clear or you don't clear, right? But every fund manager who is existing today has to qualify at least one member in their key investment team within 1 year of that notification, which is the end of May 2025.
Okay. Wow. So you basically apply. You first give the exam and then apply.
Then you get the license.
Which is typically how long?
60 days, maybe 60 days to 90 days.
Yeah, a lot of people say it's 3 months, 6 months.
It depends on the backlog. Sure. Look, in 21, 22, a lot of people are raising funds. I think, there was, a glut of paperwork. There was a glut of paperwork. Everybody wanted to become a fund manager and it was exciting. There's lots of money, startups, everything else. So during that time, a lot of applications went in and SEBI obviously could not expand its capacity, I guess, in that short period of time. So there was a backlog. But typically it takes about that much time. They may also come up with some clarifications on your document regarding anything that they feel that they want support on, evidence of, etc. There's lots of affidavits. There are lots of declarations that you have to give. You have to submit your net worth certificate. You have to submit, fit and proper certificates, declarations. It's solid.
Obviously.
KYC.
Because you are investing people's money, you're taking people's money, so government checks it thoroughly.
It's not a small responsibility. Yeah, you're taking third-party money.
As I have applied for my fund now, Cat 1 or Cat 2, whatever, what should I do in parallel? Because it's 60, 90 days, right?
So what you should be doing is talking to investors who will help you to achieve your first close. Okay. The first close of a fund is the milestone where you do the first capital call from your first bunch of committed investors and make a first investment into a company.
That's first close.
That's called first.
And typically that's what percentage of your overall fund?
Different fund managers go by different criteria. It also depends upon the macros, but typically maybe about 10 to 15% of the 10 to 15% of the fund should be okay.
Okay. So as an LP also, I do not have to invest everything on day one. As a GP. As an LP.
No. So as an investor or as an LP, you only respond to capital calls.
Okay. Right. No money committed. Oh, no, committed.
Money is committed over the period of the fund, but cash is going to go out from you into the fund only when, as per the AIF regulations, the fund manager has signed an SHA with an investee company that they have closed the agreements with, and now they are ready to wire the money into the founder's company.
And then I have to. How do I control that I have to as a LP invest? Because see, maybe that if there's a new fund, I had committed 2 crores into it, but the first deal I'm not liking. Can I back out?
Okay, so here, look, it all depends upon the PPM. Okay, PPM is the document which is signed, which is submitted in SEBI, and there is a contribution agreement, which is a contract between the investment manager, which is the fund manager, and the LP, right? The very fact that you have parked your funds is you are committed to a certain amount of funds is the fact that you have bought into this product, right? It's like you paid the booking amount in to buy an apartment of 5 crores. True. Or in the example that he said, 2 crores. Yeah. Now you can't suddenly say, well, look, I'm not liking the view from here. Can you change the view for me? Oh. So you have to trust after careful evaluation assessment that, you trust the fund manager to take the right bets. Of course, if the fund manager is deviating or going astray or is taking too much risk, there are lots of safeguards built into the process.
There are?
There is LP Advisory Council. You can approach the regulator if you have any concerns. Yes, I mean, if the if the fund manager said that, look, they will invest at the early stage, and lo and behold, they are going and investing at the growth stage, then that's clearly outside.
That happens,
That can happen. Of course, that can happen.
but that doesn't happen usually, right?
Look, fund managers don't have the incentive to go straight from their fund model. What you pitched, because when you're playing with your reputation, you're not just playing with the returns. So, and there is no reason to call it out, right? You much rather close that fund, and if you're not confident or objective or the thesis has changed, let's say you launched a crypto fund and crypto fund has gone out of fashion suddenly, or you launched a metaverse only fund or an AI fund and suddenly nobody's talking about AI or AI is too expensive. And therefore it's not meaningful in the Indian scenario. You can say, look, my thesis is gone. I'm not going to do any capital calls. I can shut the fund down.
Okay, and you return back the capital.
You basically cancel the agreements. This is assuming that no investments have been made. So whatever investments have been made, you can also terminate the fund at that point in time, but that is not something which is normally done. Yeah, because you've made one investment means you can make more. So it is very rare.
Sure. So let's say I was creating that 100 crore fund, right? I'm putting a number to it now. I have applied for the license. I've hired the co-founder. All of that is done. Now, who do I approach to be my LPs? Is there a network? Is there information available?
Same thing like a founder. You approach your friends and family. You approach, people.
100 crore fund.
Yeah, the initial, remember the first close is 10 to 15%?
Yeah.
So for the first, it's like a seed round.
Correct. Oh, wow. Absolutely. And do you put in your own capital also?
Of course. So by regulation, SEBI has mandated that fund manager, which means the people behind it, which means the GPs, should be putting in 2.5% of 5 crore of the fund value, whichever is lower.
Of 5 crore.
Minimum 5 crore.
Okay. And that's a small amount then.
Well, depends on the size of the fund you're raising. So if you're doing 100 crore, then it's 5%. I mean, it's like a founder starting a startup and they're saying, okay, the first 1 crore will come from me, but the rest 100 crores will come from the other investors. But my equity, fully diluted, when I go to an IPO will be maybe 10%. So actually the entire, your 1 crore is 10%.
That's right.
So it's very similar to a...
But tell me that, I'm wanting to create a 100 crore fund. I have 1 crore I've put in. I've reached out my friends and family. Max 2 more crores. Then how do I get down to the others?
Well, you have to go and approach the LPs. Yes. And for that, there are multiple routes. There is wealth managers, because you're basically talking, when you're talking VC funds, you're talking ultra high net worth and, high net worth individuals for whom, this is an asset class that they can allocate 1 or 2% to of their entire net worth. And they're willing to take that risks. Right, because they've got a high net worth. So to approach them, if you have the social networks, go ahead and approach them. That's the best, because then you don't have to pay a fee. But if not, then you have to go through wealth managers.
Oh, again, IBs in that sense.
Well, yes, a bit like IBs. So wealth managers, you're right. So if founders and startups, if you don't have a network, then you go through IBs and approach fund houses. Similarly here, you have wealth managers. So there are dime a dozen names.
Like what?
Well, there's, IFL, Centrum.
Also, because they manage so many people's wealth, you can approach them and then they'll take a fee like an investment banker IB, right?
Private bankers typically, work with high net worth clients only. So large family offices, etc. So they're the people who you approach to. You position your fund as a product. They will look at it versus other maybe venture capital funds or other products. And they'll then, if they feel that it's worth recommending, then allocate it, accordingly in their client's folio, because they're managing a large part of that client's folio or the entire folio, as the case may be.
And this, when let's say I'm approaching an LP and there's a commitment to call of the overall 100 crores built now, anyways, I have to put in only a few percentage points, right? 10-15% of it on day one. Right? But do I get something in return, a paper that, hey, I've invested this money in this?
Yeah, there's a contract, right? There's a contract. You get
just like an SHA.
There's a contract, you get a statement of account. Every year, a typical fund would engage with a Big Four auditor, and generate a yearly NAV statement. No different from that of a mutual fund.
Almost like an NAV statement.
That's right. So you will get an NAV statement, you'll get a profit and loss statement. As number of startups, grow in value, you'll get a value. And that's how the NAV is arrived at. Every quarter, you will have a Zoom call. Typically, every year you might have an annual day or an AGM being organized by the fund manager. So you can direct ask questions, and they all normally organize, panel discussions, etc., to make it more interesting, and to showcase maybe the next fund or some of the companies, so that you can meet some of the companies' founders that the fund manager has invested in. So it is all par for the course, very much like founders would give MIS. You would
Almost like that. I'm finding this journey to be very close to a founder journey in that.
Yeah. It's the mirror image, right? So this is now you know why all your investors are troubling you for MIS by the 10th of every month.
No, they don't. I send it automatically. I've learned that. I do that.
Yeah.
But I think so. Let's say the fund is built, and now you said that some way you'll find the wealth managers to find your investors. And I'm sure if you're putting a 100 crore fund, you might have an eyesight to 25-30 crores. That's when only you'll get out, right? To build a fund. But let's say the fund is built. How to hire the right team? What is the structure of a team within the VC?
So look, these are lean teams. You have a few investment leads, right? These are people with experience and usually track records, or operating experience.
And you call them what?
These are the partners, typically partners, right? In larger firms, you will have more than one fund in operation. A VC firm will typically deploy all its money in maybe 3 years, and then leave some balance reserves for some of the subsequent rounds where they may have to
That's also a good split that one should have in the mind.
where they may have to double down, etc. When companies go for future rounds. Typically, the split is about 60-40 or
40% for additional pump in, double down. Yeah.
Now, you can't keep waiting, so you go on and raise another fund. So typically, a VC firm will raise a new fund every 3 years.
Oh, which is when they say fund 1, fund 2, fund 3.
So it's the same team, but you'll be managing multiple funds, right? Sometimes there is crossovers as well, right? If there's an opportunities fund or a follow-on fund, then you're basically investing into the same companies, but you're investing into a Series B round, and taking your stake into a different fund, and therefore different set of LPs, and that is a different product.
But talking about the team, I wanted to hear a very important word, which will come, and I'll talk about it when you'll talk about it.
So typically in the team, you will have investment leads who are generally partners. In a larger firm where you're managing multiple funds, you may hire principals or more partners. Partners are not necessarily all GPs. GPs are owners of the fund management company.
Correct.
So the fund management company is usually an LLP or a private limited company. No different from that of a founder's, startup company. They often choose these days an LLP structure. It's more confidential and it's more tax, friendly. The owners of the LLP or the designated partners of the LLP, their profit ratios, their ownership ratios, those basically are only relevant to general partners. Okay. So while you may see...
Everyone else has a salary.
That's right. And a share of carry and a share of bonus. The partners or the principals are normally employees. They have a salary, which comes from the fee that the VC firm charges the LPs, which is about 2% of the fund per annum.
LP se lete hain.
LP se lete hain from the corpus, which they've committed. And apart from salary, you might have a small profit share depending on, again, the size of the firm and the profits coming in, which is typically the surplus of the fee, which is left over after covering for everybody's salaries and expenses, right?
Even without taking an exit?
Yes, even without taking.
What is that then?
So it's like, you're earning a fee, right? Let's say it is from 100 crores, you're earning 2 crores, which is 2% per annum. Your expenses are only 1.6 crores, then 40 lakhs is the profit share. Okay. Now, generally in a young firm, which is not managing too many funds, what's 40 lakhs? You will save that and you will keep it for contingency purposes and all of that. But typically in a large firm with large assets to manage, large funds to manage, there will be surpluses. Okay. So these may be then split between the general partners as well as the partners.
Okay.
Carry. Carry is basically the profit share that you have agreed with the LPs. Okay. provided you're able to cross a certain hurdle rate of return.
Okay.
Remember the LPs have the choice of not investing in this risky asset class and just putting it in a simple mutual fund, right? What is the return that they're likely to get from the market? Typically, let's say about 12%. So then 12% is then agreed as part of the contract to be the hurdle IRR.
Oh, is it? That's also defined.
That's also defined. So everything is, very black and white. So let's say you started off with a 100 crore fund. In 8 years, you were supposed to deliver 400 crores. That would have meant only the hurdle rate being returned.
12% is only 4x? 12% is 4x. Mota.
8 years, 9 years. I'm just throwing in numbers. Plus the 100 crores is not withdrawn on the same day, right? So this is IRR. The capital calls decide that. So let's say you were supposed to meet the hurdle rate of 12% at a 400 crore level. After that, you delivered another 100 crores. So in that 100 crores, typically VC firms will agree that, look, you take 80 and I will keep 20 as my bonus or performance fees. This is called carry.
Okay, so this is agreed with LPs on day one that, hey, I'll give you X return, but if I overperform, then I'll take a portion of that.
That's right. It's a performance fee.
It's a performance fee, which makes a lot of sense.
Yeah, it's a performance incentive. It's like a sales guy over-delivering on his targets. Yeah. So that's called carry. And the team which worked on that particular fund and therefore its companies and its administration, depending on the contracts that have been signed with each of them, right, you will get a share of that carry.
Of that profit on exit. And there's no downside, right? If there's no profit, like some startup tumbled.
If you're not able to deliver, even the hurdle rate, it'll make you difficult to raise your next fund. The LPs are not going to be pleased at all. So your track record goes for a 6. But yes, is there a penalty for delivering 300 crores instead of 400 crores? No, there is no penalty because this is a risky asset class, right? And LPs do recognize that and they go in with their eyes open. Do they feel happy about it? No, they don't feel happy about it.
Obviously. I mean, you're gone in that sense and it's a tough ride. It's a failed founder. Okay. So in you said that there are LPs, GPs, and then principals, partners. There's a very important term which I want to discuss, which is the analyst.
I didn't know you were heading towards that.
What is the job of the analyst and how important it is?
Okay. The favorites of all founders.
The non-favorite favorite.
So, look, the analysts, in the truest sense, right? They are supposed to do 2 very important jobs. One is sourcing. It is more important in early stage, less important in the latter stages, because by that time the companies are already discovered, right? Attrition has already happened. Those which had to shut down, they have shut down. Now there are 3 guys remaining. What is there to discover, right? The number of funds is also smaller, so they will naturally come to you only. So the sourcing job is not very heavy. And it becomes more of an admin, like, setting up meetings with, principals and partners and all of that kind of thing. The more important job, so let me split this up. Sure. Early stage VC sourcing is very important. It's almost like 50% of the role. Okay. Because the number of companies that you're filtering through is very high.
Too many early stage
companies, the senior guys, the investment leads can't meet 20 edtech companies in a certain segment of upskilling. You have to burn it down to 4. So the 20 to 4 is done by the analyst. Based on a certain set of criteria and guidelines that they have agreed with the partners, and when they have a doubt, they will check with them. Okay? Or if they have a very high conviction, which gets better over a period of time, and generally, people in analyst roles are typically consultants or people who have again worked in startups, because then they can be scaled up to become partners.
But one thing is clear, that one is the consultant, the other is the founder. Yeah. So as you've said earlier also, maybe an operator would be better, right? A founder
would be much better. A founder operator would be much better, right? So they're able to filter that. That's 50% of the role. The balance 50% is a lot of things. Sure. It would be scanning for thesis. So hypothesis will be formed by the investment lead. Typically, in firms which do such things, the analyst will go ahead and look for data to validate or invalidate that hypothesis, right? So that you form a point of view. For example, I can take an example that I led this investment into an edtech company called NextWave, or even a e-mobility company, Battery Smart. So there, the analysts were tasked with looking at how large the e-rickshaw market is today, how large the two-wheeler market could become when ICE changes to EVs, what has happened in China, because that was a clear market where this transformation happened and two-wheelers exist in large numbers, right? So the typical analyst job would be to do exactly this, right? Similarly, in the edtech space, we created a whole map or whole segmentation by studying China, US, and our own market. And we looked, by looking at data, looked at what could be the gaps. Because, you need an inspiration, right? And then you also localize what is possible, what is not possible, right? So you divide the market into different segments, look at the sizes of those segments, try and predict or come as close to an estimate of the TAM, which is called TAM and etc. You look at what are the problems existing there. Can those problems be solved by technology? So therefore, does it make sense for us to look at startups coming up in this segment? Have there been some investments made in those countries along those lines? Or is it a completely fresh business model only meant for India? Which is also okay. For example, this edtech company called NextWave, we didn't see a comparable upskilling example for computer science education with a mix of vernacular and English delivered online. For engineers from lesser known colleges. Seeing the huge demand for entry level software, coding talent, and the mismatch between engineering seats in computer science versus other traditional disciplines like mechanical and electrical. So there were more mechanical and electrical engineers coming out and still come out of India's engineering colleges than the number of computer science jobs that are existing out there. So how do you bridge that? Right? And those students have a need for or have a better comprehension and ability to scale up their learning in a parallel course when they are in a vernacular plus English medium rather than an English medium purely. So that's how the NextWave investment.
Going deeper into the thesis, the market, beyond what founders say.
Absolutely. Visit even the market. So for example, when I had led this investment called Varaha in terms of carbon credits from agri-sources, I had the team visit farmers, right? Saying, let's get a first-hand view. We had little time because, we knew that they were in the market and looking at different funds. So we had to be speedy. And I have no qualms in confessing, that we wanted to, cut to the chase. But we needed the data. So to complete the diligence, we met those farmers. We understood what Varaha was doing over there, for example, and how it would translate into what we could see happening down the line, right? We also had to have a point of view on how carbon credits will come into existence. Even today in India, there is no carbon exchange. There is nothing like this which exists over here. It exists in the foreign markets and they are far ahead. But would it happen in India? Of course, it will happen in India. Right. Because if India was going to industrialize, we were already the third largest polluter. So we'll have to buy those credits. Because when you're signing up to a COP28, COP26, whatever, all those global summits on climate action, and India is committing to its NDCs, you will have to bring it down, and the SEBI notification for top 1,000 listed companies had already been announced.
Absolutely.
So look, in VC space, you also have to catch the trend when it is just about to take off. If you start investing there, the market is already discovered. There's not much left. Where is the 20x and 40x going to come from? If you come too early, then it's going to be all on your time and money. Right? So coming in early...
That's when you'll have the maximum multiplier also in that sense.
For example, I can take an example. Look, co-living. There were a lot of co-living startups, which came 6 or 7 years ago. True. They came in 2018, 19, pre-COVID, if you remember. Yes. Right? It was too early. It was too early. Post-COVID, and you have to see the age demographics in the country. The guys who are entering the workforce, they're typically entering the workforce between 22, 23 years old. So the guys who were born in 2000, they would enter the workforce post-COVID. Their view to livelihoods, relationships, work, romance is totally different. So you can't put a product which is meant for Gen Zs into millennials. So you have to wait. Timing. So there's a lot of timing piece which is also required. Battery smart also the same thing happened. A lot of VCs rejected battery smart model when it was on paper because everybody said this e-rickshaw is illegal. Yes, of course it is illegal, but it still runs around.
That's right.
Right. So the 25 lakh e-rickshaws. Right. And so what if it is not in Bangalore? So what if it is not in Mumbai? Does it mean that it doesn't run in India? We have many Indias within India. So I think we had to take those kind of bets, saying this is today's business, could evaporate over the future, right? As GDP per capita increases, metro, public transportation goes up. Maybe the need for e-rickshaws will no longer exist, right? But tomorrow, what is going to be tomorrow's market? So tomorrow's market was predicted on the conversion of 100 million installed base of two-wheelers, which were a large portion of them which were deployed in commercial logistics. Personal logistics would take time, right? Because you're not driving that much. If you're driving that much, you'll wait for the entire capex cycle. The sheer number of kilometers that a commercial scooter runs is far more than personal scooter. So this conversion would happen much faster. E-commerce would grow. Every dollar saved, every rupee saved is extra margin for Zomato or extra margin for all the e-commerce businesses. So the conversion would happen overnight. And then models like Zip came in that made it easier for them to access fleets. And that's why the whole thing got transformed.
No, absolutely. Yeah, it's timing, right? We were also struggling for the first few years. The same story, right?
That's right.
But I think so coming back to the VC fund structure, so the team is set, right? 3, 4, 5 people?
No, so the investment team will typically have investment leads. They will have analysts, your favorites. Then you'll have in climate funds, you'll have an ESG person. In impact funds, you'll have somebody doing the impact in ESG. There will be a chief compliance officer. This is also mandated by SEBI. So you have to do lots of compliances with SEBI. You have to continuously upload documents and all of that and fulfill all that documentation. So there's a chief compliance officer, often doubles up as a chief financial officer as well. There'll be a accounting team and a HR and a legal person, because obviously you're doing a whole lot of shareholding agreements, etc. But a lot of it is outsourced to law firms and consulting. So the big 4, big 6 to generate some of those NAV reports, audit reports and all that. So I would say that, look, you can run a 2,000 crore 3 to 4 fund kind of an operation, right? With about a team of 15 people.
2,000 crore?
2,000 crore arm.
Capital?
Yeah. Wow. Yeah.
100 crore, you need then 4, 5 people.
Look, the number of people doesn't scale up with the amount of assets.
You'll need those many people because the compliance officer will have to be a compliance officer.
That's right. So there is a certain fixed cost in every business, like they say, right? So you got to do that.
So that's how the fund is built, the team is built, and now my job is to market myself and get startups.
So hopefully, the GPs are already known. If they're not known, they have the added hurdle of trying to establish themselves. Or if there are LPs becoming GPs, which means that they were not known in the founder community, they were known to the VC firms, because LPs invest in VC firms. So LPs like, for example, IFC, LPs like CDPQ or CPPIB, etc., some of the pension funds, large funds. If those partners, they also have partners. So if those guys are now becoming GPs, then they are not known to the founders, right? It's like wholesale and retail.
Yeah, exactly. This is wholesale.
So one is that. Secondly, if a founder is becoming a GP, then the harder task for them is to become known in the LP circle, right? So probably the easier part is to get access to startups because they already have sourcing. That's true. Right? So I think for GPs who have come therefore with startup experience or operating experience, they are able to establish themselves much better, much faster. People who have been startup employees, people can relate to them much faster. It's more natural for them. Generally, you'll find the wholesalers don't talk much on media. The retailers talk a lot on media because they have to build up their image, and they have to source talented founders like yourself and get them across so that you can meet and evaluate and then decide what to do.
And that's how you do those mixers and you call.
That's right. You have to do some events to let people know who you are.
Right.
Because look, I mean, if you meet in a Zoom call, how can you have a long-term partnership for 8 years and sign up with someone that you met for 3-4 times?
And how can you get those 2 to 5 crores over these Zoom calls? You got to keep meeting people.
Well, in COVID, it used to happen like that because there was no other way.
That's right.
But, and it can still happen, right? It can still happen. But yeah, it is harder.
Correct, obviously.
So just as founders need to put themselves out there, I think there is a need for VCs also to put themselves out there, but more at the early stage. Series A and Series B guys don't do all these founder events and don't do all these.
They're well known already.
No, they don't have a need. They don't have a need.
Because the founders are so many to approach them already.
There are very few founders who are coming into Series A and Series B funds. No, most startups fail in this valley of death between seed and A. That's where most of the attrition happens. 9 out of 10 startups will fail.
And then so what you're saying, the number of funds who are doing Series A, B, C anyways are counted.
Anyways, they're very sort of
usual suspects.
Usual suspects. And the companies are also usual suspects. So you don't need to organize mixers to need to know people, because they're already known.
Great. So I think we've kind of covered the full journey of becoming a VC.
Yeah. So now I think anybody can become a VC, guys, after this podcast.
This is the podcast.
Yeah,
that's the reason we've done
guys,
today.
want to raise funds, help startups become Zip, another Zip.
Why is it a good time to be a VC? Maybe just a point on founders, India, startup story. Is it the right time for someone, or what is the right time?
Yeah. Look, I didn't think there is a better time than this to be both a founder and a VC. Right, and we talked about it earlier in the show. So, the macros are set. You're not hungry now to teach people how to do UPI. You're not teaching people how to adopt to new practices and habits. They're out there searching instead for solutions for their problems. Should you have it, right? So. It's become far easier for a talented team to launch something, to test it, and to scale with improvements in UI and UX along the way. Sure. Equally so, over the last 10 odd years, and I think the D-Day, and you asked a very important question because it's going to segue into something very important which is going to happen in the India VC ecosystem and the startup ecosystem. The funds which were raised in 2013-14, after numerous extensions, this is their final extension year.
Oh, really?
So all of the first funds of domestic VCs are going to have to perforce be terminated in 2025, depending on which month they started off. So somebody who started in February 2014 has to end now in February 2025, which means they either distribute cash or they distribute shares of the investee companies.
That's a lot of pressure then.
That's a lot. That is why one is hearing a lot about exits. Fund managers are out there saying, where can I exit? What best price can I get?
And that's why the advent of secondary funds and IPOs, and SME IPO.
That's correct. So a lot of the action is taking place right now, which also means that the track record will get converted from paper to actual money. You may claim that today I'm getting a 20x, but if you sell at 15x, because that's the price you eventually got, because now the timing is on your, on your back to end the fund and distribute cash, then that's what your real multiple is. That's right. So what's going to happen is that, we were talking about why this is a great time. So this is also the time, therefore, that performance benchmarks will get converted from paper to reality.
Now you know the real multiplier or the IRR. This is the time?
It is like how we had WeWork globally being rated at XYZ. Grab went up to 40 billion. There were SPACs and whatnot. But then when the actual, time came to value the company, why did it all crash? Because that's what the final public investors or people who were looking at the asset at that point of time would value it at.
So what went wrong? A lot of failures have been there. While the model is great, and I've seen you also talking some stuff on your LinkedIn about what's right or wrong about VCs. Anything that you want to talk about that?
I think, look, what I have personally learned, and I want to apply it in the new fund that I'm setting up, is discipline. I've always believed in discipline. And thankfully, I've been able to exercise it as well. So one's been lucky. The first of investments, the first vintage for me was 2018 to 2020 of the investments that I led. There were 9 investments, and there was, let's say, 100 rupees of capital. Happy to say, today as we speak on your show, 100 rupees has gone back to the LPs.
Nice.
And a 4x multiple is still invested.
Lovely.
Which means that and another couple of years to go.
Return the capital, growing.
So some of these numbers will start coming back and get converted from paper to actual cash. Right. So I don't know whether you know or your viewers might know, but there are third-party auditing agencies in our lives as well as VCs. So there are benchmarks. It is almost like, quartile.
CRISIL.
So CRISIL, Preqin, they generate a pooled IRR percentage for that vintage of funds in question.
VC funds also?
VC funds in question.
It's public?
Yeah, it's public. It's there. It's out there. So today it will say, for example, that financial year 2014, let's say there were 14 funds. Okay. They won't give out the names, but at a pooled level, the IRR, for example, is 12%. So this IRR of 12% next year will get converted to an actual number. Today it is paper, but tomorrow it will get converted. Whether it will be 10 or whether it will be 20, I don't know. Sure. But the truth will be closer to 12 as it looks like. Okay. So that is going to be a big moment in the VC ecosystem where the actual performance track records of managers who set up their first funds is going to come to light. Right? It's like seeing your results on a college notice board.
It's going to come out.
Did you clear? Did you pass?
Yeah.
Did you pass for distinction? Yeah. So every fund manager, therefore, will get a badge, right? Which will talk about how they fared. Now, that having been said, India is growing at the fastest pace. We all know that as compared to other economies in the world. India is not a developed country as yet. A long way to go between $2,600 to $10,000. That's the first milestone. In China, this same journey was done between 1995 and 2015, where China grew double-digit year on year, and took 40% of its population into urban from rural, and obviously grew on the back of the big manufacturing boom. China is a factory to the world. True. Everything gets made out of China, and that's the reason, because they focused on manufacturing, became the factory for the world, gave good quality, gave reliable quality, and that's what they grew their economy on the back of. Similarly, look, India has to grow on the back of certain booms in certain sectors and also save on precious foreign exchange while growing to be able to deliver on that GDP per capita to become a developed country. Startups are going to be playing a key role over here to harness this technology and the cheap data rates that we have as a gift and create the most efficient pathways, right, to delivering that prosperity to anybody who wants to do business, who wants to, create a sustainable business model. And that is where VCs and funds acquire a very large relevance along with founders. So I think this ecosystem is at a tremendous stage. You have the right macro ingredients. You have the right drive from the government. You have the right number of mobile internet users in the country. It's saturated now, right? So the whole market is literally waiting for you, right? The costs haven't ballooned. Sure. The cost of accessing the internet is not coming in the way, right? The physical infrastructure has vastly improved. Long way to go, but it has improved, right? We all know that. So the journey from the unorganized to the organized will be made on the back of this, right? And various business models like Zip, for example, are going to come on the pathway to this prosperity, right? So who's going to do it? It's going to be founders, and founders are going to need capital. So there is a role for all of us.
Awesome.
Yeah. So there's very happy days. The next 10 years are going to be very exciting, very exciting. And it's not without reason that we are the third largest ecosystem of startups in the world. And it's good that the government is aligned, private sector is aligned. Earlier, I came from the corporate world. Many corporates would look at it as, let them do some tinkering and we will see when they become big. But today, I think all the corporates realize that there is a real, clear and present danger from a talented bunch of founders who can set up a company and challenge anything. Right? The biggest of companies today in every space are sensing and feeling the threat. They are shaped in a different manner, which is to minimize risks. So they can't do innovation. They will become acquirers of innovation. So that will be another exit possibility, not just IPOs.
That's true. Which is what we've seen in the case of Momsco or many others, Beardo and many others. But tell me, last few questions. I think we're almost 1.5 hours. Yeah, I know. But
I think we'll have to sleep over here in the office. I hope you've got a bunk bed.
We will. We'll have a lot of capital maybe raised post this. But last one, which sectors are you kind of most aligned on or most optimistic on today?
So looking at the next 10 years, I think anything green, definitely. It makes tremendous financial sense for India to save its foreign exchange and not industrialize itself on the back of carbonizing the planet, right? And which means fossil fuels has to go out of our lives, become really minimal in this, the linearity or the correlation between growth and consumption of fossil fuels has to go away. I think we've done a fantastic job on solar. We got to continue doing that in all the other facets. And I think Zip is kind of, doing that with many other companies like Battery Smart, Overra, etc. And we'll see many more. So climate and sustainability is definitely going to be big. And along with that, all the sub-segments, whether it's electric mobility, whether it's EVs, whether it's renewables, whether it's water, whether it's, agriculture, all of that, right? Agri is a sector which has not been touched too much by startups. Okay, this is 15% of India's GDP. 40% of India's population is employed in agriculture, and we haven't touched it. So, which are the new models over here? There's $10 billion of food which goes waste because we don't have cold storage between the farm gate and the consumer annually. So can we as a country afford that? No, we need models, right? Similarly, we're going to have to continue to work on education. We are a young country.
EdTech is still hot,
Absolutely.
even after all the...
Absolutely. I took a contrarian view. It's not the K-12 space. I think K-12 is done. We've got some great players like Vedanta, etc. But what we will need is upskilling. India has about 200 odd million people, or rather youth, right? We're a young country, average age is 28 years. You can't keep giving people, BCom degrees and BA degrees in history, science and English literature and Hindi literature.
Correct.
That is not the skill set that is required for powering today's businesses. So virtually every young graduate is then, signing up for a coaching class, signing up for an extra short certificate course, etc. There is a big opportunity in upskilling. And this has to cover all sectors, right? So it's not just, and the colleges and the present educational system is incapable of handling this, right? The British system of education is still continuing. So, so I think we got to make a big stress towards upskilling to a employability, which doesn't exist today. Startups. Health, nutrition, consumer brands will continue to play. Financial services for Bharat, I think we need to do far more work over there, right? Again, marketplaces of different kinds, right? We had Airbnb, for example, come up, and it became a phenomenon all over the world, which is relevant. Real estate development, we know, is taking place very effectively. So how to sweat some of these assets and create parallel streams of income? I think everyone's realized through a whole lot of social media and influencers that everybody needs to have a passive income, right? Or a second stream of income to secure themselves. But how do you do that, right? So financial services, some of these models which help, the individual asset owners sweat their assets in an organized manner for passive recurring income. I think some of these themes are all signs of how developing countries became developed. If you look at all the developed countries, this is what happened in those countries.
Last question. If I want to be, becoming a VC, are there any things that I can read or chew on to get ready faster? Beside this podcast, obviously.
I think I've always believed in practical experience. Okay. So I think if for someone who wants to jump over or has a desire to set up a VC fund, do make some investments of your own, like an angel investor. And don't do the herd mentality. Go and risk your own mind. Saying, I'm going to take this bet because I have the intuition. In a VC fund, the investment lead carries the entire weight of having taken that bet.
Which is the partner. Yeah. So basically, just don't do because your friend is investing. Do the thorough research as you would do as a VC and get your success rate yourself, your multiplier or your IRR.
That'll give you lessons which nothing else.
And actually, that's a CV that you can take.
Exactly. That look, I risked my own money. These are the lessons that I learned. Now I'm better at handling not just my money, but somebody else's money as well. Right? And these are lessons, these are hard lessons which I learned. These are not books that I read and I'm trying to now find an application in real life. It's very different from, it's like acquiring, knowledge through a classroom training versus doing an internship.
That's exactly.
Right? And then getting ready for employment. So internship brings you to the earth, right? You say, oh, this is how it's done, is it? In real life.
The book didn't say that.
The book didn't say that. That's one. The second piece, I think, is it's always good to find internships in a VC firm. And if you're young and, if you're aspiring, go ahead, join up, appear, network with founders. I think there is a personality match as well, right? If you're shy of networking, maybe growth stage applies to you. If you're more the, balance sheet types and profit and loss types, maybe that applies to you, right? Maybe reading newspapers and reports is much better for you. But if you're an early stage VC, you'll have to do all of that, plus do networking as well. True. Your brand has to be alive all the time, right? So you have to be relevant. You have to be out there being relevant to founders. You have to roll up your sleeves, work along with the founders, spend time. One of the things that my folio founders have constantly played back to me is, Anup, what we really appreciate about you is the time that we spend with each other, right? And very often there is no agenda, right? Some things definitely have structure, but you brainstorm on things which are important, and you just need to drop your guard and, feel like there is a friend of the business over there, a true co-founder, right, who's come over there and who's brainstorming some of these solutions with you. Nothing may be right. There is nothing which is prescriptive, but it helps you to think better, right? I wouldn't call it mentoring. I think it's just being a friend of the business. So what does a friend do? They just sit down with you, give you their time, give you a shoulder, right? Does everybody have, high moments all the time? No. There are some high moments, there are some low moments. You need a friend to pick yourself up. You need a friend to celebrate with. So that's it.
No, I think that's such an interesting point because I'm just remembering that I have a few people on the cap table, but every person who's called me, who's invested in me and called me versus the people whom I have called, I think they're so different. And hence, as a VC, you need to be that person whom the founder is calling out to.
True.
Not the person who is calling the founder, right, for something.
True.
That's the true relationship that can be built.
So why do you do that? It's because there is you can be yourself
And I can trust them.
and you can trust them.
Hey, there's a problem, I need a solution.
There's a true friend, right? So they're thinking about you. They're interested in the business. Very often, fund managers or VCs have been accused of, or I would say, blamed for saying, "Oh, okay, put all the pressure on the founder. When the founder doesn't do well, wash your hands off and you carry on." Yeah, well, maybe your problems are your problems when the problems happen, but when your achievements happen, then I'm going to be there.
Yeah.
So say it was mine. I did something for it. So very often I've heard that, but I think if you've been in the trenches, if you've been on their speed dial, like you mentioned, that means a lot, right? Very often, look, founders also know in their mind that for a certain kind of a problem, maybe it's that person, is that investor or that VC who will be more relevant for me to speak to, because the other person may not have the background. Generally, I've seen that they are not very good on those kind of issues. That also happens.
So lesson for VCs, be on the speed dial of founders.
Earn your place. I think it's always more than capital. You want smart equity on the table. And I would say smart with a heart.
So nice and so much to learn. So good to have you.
Great, Akash. Yeah.
So nice. Thank you
Hey,
so
great,
much.
yeah.
Now the bunk bed is ready, so we
Thanks for
can.
inviting me.